All right. I am losing my voice already today, and we haven't even started. So, with that, just a quick warning, and this may be a short class. Okay, let's get started. The first thing I want to do is I want to jump right into my spreadsheet and let you guys see the spreadsheet. If you look out on the little marquee out front, that's what it said, the little thumbnail said we're going to look at our spreadsheet today. Now, the reason I wanted to bring it up is because I've done a lot of work on this thing, and I think I've about got something to share. And so I want to bring it over and show it to you. And my spreadsheet, of course, is of my portfolio and what I'm trading and how much I'm making. And I think that's always fun to see somebody else's portfolio and see what they're doing and seeing if I can maybe learn something from what they're doing. And I'm not here to tell you what to do. I'm just showing you what I'm doing. And so this is what I'm doing. If you want to see what I'm doing, then you can take a look. I've made $332,000 this past 12 months. So if that interests you and you say, well, I'd like to make $332,000 in 1 year, then come in, and that's just one account. This is my first account. My second account, I made 77,000. So add that. Oh no, that's parity. Trading account. Oh, that's the wrong one. Here it is. I made 69,000 in the other account. It's a smaller account. So if you add 69,000 to 332,000, that's the difference. All right. So what's that? 3, 6, 7, 8, 9, almost $400,000 last year. That's pretty good income, I think. I mean, I know there's other people who make a lot more, and if you find that guy, you should go watch his channel instead of mine and do what he's doing. But until you find that guy who will show you his portfolio and say, look, I'm making this kind of money and I'll show you how, hey, come stick around with me. That's okay. I'll show you how I did. All right, so let's come in here. And the reason I want to show you this new spreadsheet is because I want you to think about the, let's see if we can get more of it on the screen at a time. Maybe that'll help. Ooh, it's just not very big screen. This is a big spreadsheet, and I have a big 4K monitor over here, and that's the one I work on. So when I'm looking at it, I can see the whole spreadsheet at once. Not that you really need to. You can kind of scroll your little window around and take a look at it. But I want you to think about the stock market, and I've talked about this many times before. The stock market is like a sandbox. All right. We got some new people who come to class on occasion. So let me kind of just refocus our center a little bit and give you the idea, the concept of what we're doing here. The stock market is like a sandbox. And when I say that, what I mean is that you can go into this sandbox, this stock marketplace, this financial world, and you can structure your trading idea concepts however you want. All right. You can look at it however you want. You can create almost anything in the stock market that you can see out in the physical world. So if you like to flip, buy low, sell high, you can do that. All right. So if you're in real estate and you like to buy houses, fix them up, and then sell them for more money, well, you can do that in the stock market. And that is primarily, I would say, well, I'm not going to say 90%. I'd say 50%. 50% of people who trade, it might not even be that many, because there's so many people who just like to buy and hold, right? They like to, that's like buying a house and saying my house is an asset. So buy and hold people who just put their money in the stock market and just leave it there for 20, 30 years. That's one strategy, and that's a very large group of people. A lot of people do it that way. And I'm not talking really about those people, because that's more of a 401k type. I go work for, big corporation, or I go work as a school teacher, or I go work as a fireman or whatever, police officer. And they take money out of my account every month and they put it into a 401k for me. So when I retire, that money will be there. And then they'll do a little matching to help, make me feel like I'm saving for my retirement. And so they do that kind of thing to kind of get you to stay. Oh, we give you money, so if you'll stay, we'll match your retirement. So they put that in there, and there's a lot of people. I mean, almost Everybody who works for any kind of company, corporation, other than a real small business, even real small businesses are being forced to do that kind of thing for people to get them to come and work for them, right? But I mean, my company, when I owned it, I had 21 employees, and I do it, right? I mean, I would give very beautiful benefits. So even small little companies do that. But anyway, if you're self-employed, it's a different story too. But nonetheless, we're getting off on tangents. The point is that that's one model, and there's a lot of people that do that. Now, you take a group of those people, and some of those people will trade on their own. They'll manage their own money. They'll go in and trade. I would say that's a smaller group of people. It's getting to be more. There's more and more people who are doing self-directed trading and investing. But the majority of people just throw it into a 401k and somebody else trades it for them or invests it for them. But for the group of people who are out here trying to make money on their own in the stock market, I want you to think about the different ways that you can manage your money. And the stock market, again, is like a sandbox. You can do so many things, and it's really all has to do with your head. What's up here in your mind? But there's different ways to reproduce what we do out in the physical world in the stock market. So going out and buying a house as an investment and living in it, well, that's the long hold, buy and hold, right? At the end of your life, you have this money that's all built up, this equity in your home, but if you sell it, you don't have anywhere to live. Well, in the stock market, at least if you put a whole bunch of money in there at the end of the, when you're ready to retire, you have this little nest egg of money, you can at least start to spend it. The problem with that is that when you start to spend it, you could eventually spend it down. And this is the biggest concern most people have, right? At the end of their professional careers, they want to retire and they have this little nest egg of money and they start to spend it. They spend it down until it's gone and they outlive their money. And that's the biggest fear most people have. All right. And so how do they get around that? They do other types of investments. And so you might see people who have 401ks also buying and flipping houses. I'll flip a house. I'll buy a house and fix it up and sell it. And that's a lot of work, but you can make money doing that, right? Some people do. I mean, sometimes you end up selling it for less than you bought it for and put all your work and labor into it. And then you end up selling it for less than what it was worth. And you didn't make any money. So you went through 6 months of doing that and you didn't make any money, or enough to cover the 6 months worth of time and labor, right? So there's risk in everything you do. And so people are like, well, I don't want to go trade the stock market. It's too risky. Okay, well, go flip houses in the real estate industry because that's not risky. All right. So risk is what you think risk is. I mean, it's all in your head. And that's the point of trading. Everything is in your mind. I mean, how are you thinking about your assets and how are you strategizing them and how are you structuring them so that you can, in your mind, make money? I mean, it doesn't everybody just make money in the stock market if the stock market goes up? No, that's not necessarily so. It's good for the stock market to go up in most strategies. Of course, you can make money when the market goes down too if you structure your system properly. So, but the market has a tendency to go up more than it goes down. Let's see. I think I have a little. No, it's not in this folder. Or is it? Is that it right there? No, that's not it. Okay, I got a little image that I thought I had on my desktop that I was going to show you, but it's not been brought over yet. So anyway, it would show the bullish nature of the market versus the bearish nature of the market, and the bullish nature of the market is much more. We have a lot more bullish side of the market than we do the bearish side. So you're going to make more money in strategies that make money on rising markets than on falling markets, and that's the point that I want to make there, is that you generally, make money more readily when the market rises. So when you set up your strategies, you kind of want to have that bias to your trading strategy. The market's going to rise and you're going to eventually make money over the long haul. And that's why people will buy and hold just for the long haul. But if you want to do better than just, buy and hold, which hasn't been a bad strategy in the last 3 months, right? In the last 3 months, this market's done nothing. 4 months, it's just done nothing but go straight up. That's good strategy. And most of us, in this class, we've been doing a lot of that. We've been buying and holding our long-term or our investment strategies that pay back our dividends. So the whole point is that you can set up multiple types of business type structure enterprises in the stock market to mimic what we do out in the real world. So the first one, of course, is, as I mentioned, it's the flipper mentality. You buy low, sell high. So if you're going to buy low, sell high houses, well, you can buy low, sell high stock. And that's what most people do when they're doing their own trading. Not the long-term holders, guys. I'm not talking about those guys. I'm talking about the people who actually manage their own money and trade. They come in, and what they do is they, buy low and sell high. But most of them, the problem is they get stuck in that mentality where they don't sell high. They don't ever sell high. They just buy. And then when the market falls, they wait and they buy more. They buy more. They don't use their own money to buy more because their own money is in the market. I mean, any profits from their money, when I say their own money, I'm meaning the money that they've got in the stock market. So they put 10,000 in and it rides up to 10,000, up to 12,000, and then it drops back down to 9,000. That's where they buy more, but they don't use their own investment money to buy more because that they just left in there. This is how most people trade, right? It goes down to 9,000 and they put 10,000 in. Oftentimes they'll sell at the 9,000. They lose the 9,000 and then market turns, starts to go back up. So then they buy again, usually about where they would have got, where their 10,000 was. And then it goes back up again and they get back up to their 12,000 again and they feel like they're traders. It's not a very good way to trade. All right. We need to buy low, sell high, and people just don't sell high. And we've talked about that a lot in this class where you got to take profits. You got to sell high. When a market gets high, how do you know market's high? Well, you do mathematical projections and calculations and you look at previous trends and you say, well, markets generally do this. And you look at the fundamentals. We don't want to ignore those, but we look at the fundamental nature of the markets, what's causing the market to rise. And then we look at when a market starts to get high, we start to dollar cost average out. It doesn't mean you bail out all at once, and it doesn't mean you bail in all at once. We don't bail out of markets. We don't bail into markets. All right. When we do this type of trading, when a market starts to get really high, we start to slowly take profits off. All right. We dollar cost average out because the market can continue to rise, and we don't want to be completely out of the market in case it does continue to rise. But once it gets up into these statistical high ranges where we think the market might start to turn around and have a little drawdown, right, buy the dips. When we're thinking market's getting ready to dip, we want to have some money to buy the dip with. And if we haven't sold any off, well, we don't have any money to buy the dip with. And that's the point I'm trying to make here. Most people, when they trade, they'll put their $10,000 in. It rides up to 12,000. They don't take it out. And then it goes down to 9,000. That's where they take it out. And then it goes back up to 10,000. They put it back in. It rides back up to 12,000. They're up another $1,000, but they're really down $1,000 from where they would have been, right? But they're still profitable, just not as profitable as they would have been. But at one point, they sold low, so they lost 1,000, which they had to recover to get back to break even. And then they made another 1,000, but then the market's just right back to where it was. And they're $1,000 less than they had before, but yet they're still profitable. So they feel like they're a good trader. Oh, I make money in the markets. All right. But yet the big boys, Aladdin, took $1,000 out of your hide when you trade like that. So the point that I'm trying to make is don't trade like that. But that's how most people trade. So what we need to do is we need to, when the market starts to get up into these high levels of probabilities that we're reaching a point where the market might dip or turn around, which is, as you guys know in this class, the three-drive Elliott wave pattern. Once we get up to those tops, the probabilities of the market continuing to rise starts to get less and less and less. So once it gets up there, we want to start taking some profits off slowly, just dollar cost average out of the position. And you can always leave a little bit in, all right? So if you've made a bunch of money, we'll start taking some profits off as the market hits new highs and new peaks. You can take some off at those high peaks. And then when the market starts to turn down, you're going to have some money on the sideline that you can buy low with. You got to buy the dip. And if you're going to just have to run out to McDonald's and get a job and work so you have a little extra cash to buy the dip, well, you can do that too. But that's kind of defeats the purpose of what we call exponential growth. The way you have exponential growth is that you take the money that you earn and you put it back in and buy more shares. That's exponential growth. And you don't experience exponential growth if you're not doing that. All right. You got to use the money that your profits to buy more money. All right. Buy more shares. Okay. Now that's a whole different concept to people than the flipper mentality. The flipper mentality is you buy it $10,000, it goes up to 12, you sell the whole 12,000, you made 2,000. You wait for the market, go find another market that's down low that you think is going to rise. You put the whole thing in and away it goes. And you might diversify and do that a little bit, 2 or 3 times. But that's a whole system of going in and a whole system of going out. Buy low, sell high, and then go look around for something else to buy low, sell high. Go look around for something else, buy low, sell high. It's the flipper mentality, right? Now you can do that, and there's just different variations of how you can do it and how you can make money and how you're going to lose money. Make money more slowly or make money more quickly, and it's just the different strategies. That's what I was saying. Most people will, they write it up and then they write it down and then they get out, and then when it goes back up, they put it back in and they ride back up again and they think they made money. But they didn't. They actually lost money. All right. And who took that money? Well, it was the big banks and hedge funds who trade against you like that. That's how they want you to trade. You didn't really make any money. You lost $1,000. Okay. Now, yes, the $1,000 was a paper loss, but so is your $1,000 gain. It's also a paper gain. So somebody realized that, and it wasn't you. That's the point that I'm trying to make when you trade like that. So be really careful not to trade like that. So the way you get around that is changing your mentality, doing a different strategy. Don't do the flipper mentality. Don't do that. So what we want to do is when a market starts to get, we want to do the buy low, right? And then when the market starts to get higher, we want to average out of our position so that we have some of our own cash from the market, some of our profits, that when the market dips, we can start to average back in. All right. And we don't know where the bottom's at, but we get pretty good at it. In this class, we teach you how to read the markets like a book. And we get pretty good at knowing where markets are going to probably turn around and maybe have a better idea of how to get back in. So that's where we don't ever catch the exact top and we don't ever catch the exact bottom, but we can average in at the top and we can average in at the bottom. And if you'll do that with the money that you make in the market, that's where exponential growth comes from. And that's how you compound your money. Sorry, I'm going to take 1 second, drink some water. I don't think I have a cold. The seasons are changing up here in Cache Valley. I think I've got allergies. So dealing with a little bit of that. So here we go. So the whole idea of the concept is to structure a trading strategy that works like that for you. And you're like, man, that sounds hard. I don't want to do that. It's really hard. I know it's hard. That's, if it was easy, everybody would be doing it. But there's a way to structure it so it's not so hard. The reason is because you don't have to do it yourself. There's people who will do this for you. And we talked about that in one of our previous classes where you can go and we talked about ARKK and we talked about Kathy Woods, and she does that kind of thing. And you can go and have her trade your money. You just give her your money and she'll trade it for you. And you can get those types of, events, event returns, because that's how she grows her account, is by she does the buy low, sell high, averages in, averages out, and she'll send you an email and she'll tell you exactly when she's buying in and buying out. All right. So you can try and follow along and do it yourself, or you can just give her your money. Or there's other companies that also do it. And Kathy Woods is all about growth. All right. So if you go over to her fund, we'll just kind of just recap what we talked about in our last class. The RKK, and actually, that's her fund right there. So if you would have bought it right here, and this is a diversified fund. So it's not just like saying, oh, well, I bought the S&P. Well, the S&P is a diversified fund too, right? It's across the S500. The S&P is across the 500 biggest funds. So it's a diversified fund. That's what it is. But she's diversified too. It's not like one stock. It's not like buying Apple. Now, why would you buy Apple, or why would you buy Amazon, or why would you buy Meta instead of just a diversified portfolio like ARK or the S&P 500? Well, because those have a tendency to explode and go up 100, 200% in a year. Now, it's not very often that they do that, but they do that on occasion. And if you're in them, you can capture those great big moves. And that's the idea. But if you don't realize them, then you didn't really catch them anyway, right? Because oftentimes those big funds will go up and then they come back down. So they might have a 200% burst in one year, then they lose 100% or 50% of the last move. So they really only made 100%. So if you don't do the dollar cost average out and dollar cost average in, if you don't realize those gains, you're just doing the buy hold thing. You might as well just be in the S&P. All right. If you're just going to hold for a long period of time, you're building your own little portfolio and you're saying, well, I got 10 stocks and I'm just going to hold them forever. Okay. Well, you can do that, but there's probably somebody out there that's better at that than you. Not that it's not fun and you can do it. It's like a video game, right? It's an adult video game. And I don't mean that kind of adult video game. It's a video game where you're playing. But there's all kinds of ways in the stock market to build strategies that are going to help you capitalize on your income. The point that I'm trying to make is that you need to be able to compound your money. All right. And if you're not doing that, you're missing out on the largest part of your income strategy. And if you just put your money into the S&P 500 and hold it for 20 years, you're not exponentially compounding your money. You're not taking profits. You're not getting out, taking the money that you earned, actually realizing it. And then when the market goes down, dollar cost average into those dips, and then using that profit to reevaluate and re-profit again. So you're making profits on profits. If you're not making profits on profits, then you're missing out on the whole world of exponential growth. And that's why somebody who is a firefighter or a police officer or, a school teacher who puts money into a 401k their entire life, at the end of the year, at the end of their life, they have $150,000 or $200,000, maybe $250,000, because they didn't get any exponential growth. All right. All they did is they put their money in and they just got linear growth. All right. So they bought 10 shares for $10, and in 30 years, they still have 10 shares, but they're now worth $50. They still have that same 10 shares. No, Lan, I'm putting money in the whole time. That's true. You are. You're putting money in the whole time. But each time you put a tranche of money in, every 2 weeks they take money out, or every month they take money out, you're just buying another group of shares, tranche of shares, right? And then that tranche of shares will grow linearly. It doesn't take profits from it, and it doesn't reinvest its profits and make exponential growth. I hope that's clear. That's how you make money in real estate. You buy a house, you make profits, you take that profit plus your money, your initial capital, and then you go buy another house, and that money, that profit you made, goes back in to buy another house and another house, another house, and before long, the money that you made to buy the original house is free and clear. You've made all that, you set it aside. Now you're working on house money, right? So if you go to Las Vegas and you start gambling on money and you make some, and you take your $200 that you had in your pocket, put it back in your pocket. Now all you're doing is gambling on house money, right? That's where that term comes from. So now you have house money, and you have really no risk because your $200 is still in your back pocket. Well, if you're going to do a 401k for 30 years, you don't ever trade house money. Never. Because you don't ever have house money. You have it, it's unrealized gains, but you never take that house money and reinvest it to make more house money. All you're doing is a linear growth. You bought 10 shares, those 10 shares will grow to be at $10 to $50, and you still have 10 shares. What we need to do is we need to get more shares growing to $10. And we do that by buying and selling, buying and selling, and buying and selling. Now, a lot of people don't want to buy and sell. It's hard. Oh, it's hard, Lan, because I buy low and I sell high, or I sell high. I buy high and I sell low, because that's usually what I do. Most traders, when they try to do their own trading, they buy high and they sell low because they want to buy a stock that's doing well. All right. Everybody wants to do some, whenever you do anything, you want to do well. You've been taught since you were kindergarten, Mrs. Penny in kindergarten, right? So you always wanted to impress her. You want to do well. You want to draw the picture, the ducks just right. You want to do well. Everybody, we've been taught our whole lives to do well. So when we get in the financial markets, we want to buy a stock that's doing well. And so when is the stock doing well? When it's really high, when the odds of it continuing to go higher are really low. So you don't want to buy a stock that's doing well. You want to buy a stock that's doing poorly, but has the potential to do well. All right. So it's done well in the past, but it's not doing really well right now for one reason or another. But we think it's going to come and turn around and go and do well again. That's hard. I know it's hard. So what we do is we use different strategies to help us make that decision. And it's hard. So you come in here and you try to make your own portfolio. But the point that I'm trying to make is that there's other people who will do that for you. And that's where I'm going to turn around and come back over to my own spreadsheet. And I want to show you that's how this spreadsheet right here is working and functioning. And it's a mindset. And the reason, and I'm going to tell you, a lot of you guys know that I like the yield max funds. And why do I like the yield max funds? You go out and you look on the internet and they really have a bad reputation. Lots of people hate them. Why does Lan like them? Well, I like them. I'm your Mrs. Penny. Make sure you draw those ducks real well with your crayons, Bruce. So the point is that the reason I like the yield max funds is because they take profits along the way. All right. That's the whole idea, the whole concept of the yield max funds. If a market's starting to rise, they dollar cost average out their profits along the way. So they're taking profits along the way, just like the big banks and hedge funds do. So once the market gets really high, the big banks and hedge funds, they start to run out of money or run out of shares because they bought them all down low and they sell them out all the way up. Now, when the market starts to turn and come back down, they start to buy back in, right? They dollar cost average in on the way down so that they can dollar cost average out on the way up. Now, most traders, individual traders, don't do that. They try to do tranches. I'm going to buy a big bunch right now. Oh, I'm going to buy all my stock right now, and it's going to rise. I'm going to be rich, rich, rich beyond my wildest dreams, and I'm going to sell it high. But then they never sell it high because they're waiting for it to go higher. And most of them, I don't know why, but they don't think about just selling some off. Well, it's really high and I'm making money. I should sell some off. It's because of fear and greed. Very greedy. We're very greedy people. And so when a market gets high, we don't want to get out because we want more. We think it might go higher. So rather than taking some off as markets go up, we just hold on to it. And then when it falls, we're like, well, it'll go back up. So it falls a little more. It'll go back up. I know it will. And then it's below where we got in and we're losing money. We're like, oh, shit, I don't want to lose any more money. So they get out. And then when it turns and starts to go back up, they get back in and they start making money again. They think they're profitable. But really, they just lost a big chunk of money. All right. So the nice thing about yield max is, are they the most profitable way to make money? Probably not. I mean, there's always people out there. The reason they don't like something is because they can always find a way that you could have made more money some other way. You could have made more money if you'd have bought options and just long calls. Okay, yeah. Hindsight's 2020. Had I done that, I would have made more money. Doc Brown, that's his strategy. He buys long calls and makes lots of money. Of course, I've seen Doc Brown lose millions of dollars when he buys his long calls and the markets go down. Now, he had millions of dollars to lose, but nobody wants to lose millions of dollars, right? So are you going to sacrifice the opportunity to make millions and millions of dollars for maybe half of that, a little bit less, but a little bit more secure? Because the nice thing about yield max, the reason I like it is because when a market goes up, they take profits along the way. And that's been my strategy forever. For those of you who have been working with me I've been doing this for 25, 30 years. That's always been my strategy. I've learned that strategy at the Board of Trade. You take profits off along the way. Take your profits along the way. I've said it forever. It's been a mantra of mine. Take your profits along the way. And then when the market dips, you have money that you can buy the dip with that's not going to go get out of your McDonald's money that you earned working at McDonald's. You've got cash on the sideline that you can now buy, and that is the money that's going to make you more money. And yes, okay, your original might drop and dip a little bit below the original point. That's called a little bit of a drawdown, but at least it's not all of your money. And now you got some on the sideline that you can take and put back in. Okay, at the dips, because you've been taking profits along the way. And that's what yield max does. So if you're going to have somebody else trade for you, that's what I like. I like yield max because they take profits along the way. Does Kathy Woods take profits along the way? She does, but not in the same sense. So if you go have Kathy Woods trade for you, you're going to make basically the same thing as if you were a flipper. You're going to go to Kathy Woods, you're going to give her your money, and then if the market goes way up, right? She's doing that. She's making profits and buying and selling all the way up this trend, trying to outperform the S&P 500. We can go see how well she's done. Let's go, just a little sideline for fun. Let's go look at our little tool. Where is it? Where's our little tool? Oh, I haven't got it up. Here we go. Let's go look at our little tool. And we're going to compare Kathy Woods against the S&P, and you'll see that the difference between buy and hold versus buy and sell, because that's what she does. Compare and perform. So let's see if she's outperformed it. And we're going to come in here, and there's the S&P. We're going to take out HUI, and we're going to put in ARKK. So Kathy Woods is the blue and the S&P 500 is the yellow. All right. So Kathy Woods, she buys and sells. Buy, sell, buy, sell, buy, sell. Take profit, buy the dips, take profits, buy the dips, take profits, buy the dips, buy and sell, buy. She's constantly buying and selling. Again, you can get an email from her. She'll tell you everything she buy and sell every day. You get an email from her. Let me go see if we got one today. Maybe it's too early. I always just throw them away. But I mean, after I look through them, I throw them away. Oh, there's one. Oh, no, that's not her. ARC. There it is. Okay, so I saved one for us. All right, let's pull this up. So I will try to show you one last time. There she is. All right, this is what her email looks like when she sends it to you. She bought ARCHR, Archer Aviation, in her ARKK fund, and she sold Guardian Health. And she tells you how much right here. Here's ARQ. She bought these and she sold this one. And here's ARKGG. She bought all these and she sold these in this fund, ARKG. And then in the ARKF, she bought those. She bought that one. And then ARKK, she bought these and sold these. Now, it's not just Kathy Woods, one person. She's the CEO of a big firm that does this, but she's the head, right? So they work as a team to trade. And so you can see how much she's outperforming the S&P 500. She's doing a lot better. She's up, let's see, as of today, she's up 85% and the S&P's up 18% as of 1 year, okay? So the S&P's up 18%. That's killer. It averages usually 12. So this year it's really well. So you could be up 18% if you just put your money in the S&P and walked away. But if you would have put your money in ARKK with Kathy Woods, who doesn't just buy and hold, remember, the S&P is linear. They just buy them and hold them. That's all they do. They don't trade them. They don't turn them. Kathy Woods, she turns them. She does the exponential growth. She's up 85%. That's pretty good. All right. So that's ARKK. Let's go see what Lan's up. Lan is up for my business model. Return on investment. I'm up 73%. I'm up 73% on my own. Kathy Woods beat me. Kathy Woods beat me. So if I'd have put my $459, I would have had a little bit more than $334,000 with Kathy. So there you go. You don't have to do your own. You can just give it to Kathy, and maybe she'll do better for you. Return on investment, 73%. That's pretty good. I'm happy with 73%. Kathy would have beat me. Maybe we should put some money in Kathy, right? Once we make it here, if we make our own money, we got some money now, we can go give it to Kathy and let her trade it. But I don't want to put any in Kathy right now. She's blowing really high. We got to be careful. If you go give her your money right now, you might have to sit through a big drawdown. Who knows? We don't know. But she's in a nice little. She's in the same drive as the QQQ. So there's 1, 2, and she's going into the third drive. All right. So that's a good idea, right? We should just go give Kathy all our money instead of even do this. Maybe we could just do that. She doesn't do dividends though. So you're still going to have to take your money out. All right. And that's what I like about this one. So this is my strategy. And I just told you, maybe don't do my strategy. Just go do Kathy Woods and we're all done, closed down. You don't even have to ever come back and do this ever again. All right. So that said, I just feel like we just kind of took all the wind out of my sail. I only made 73%. She made 85%. Doggone it. She beat me. All right, but I got some in here that are doing pretty well. This one made 36%. This one made 61. This is making 38. This is 61, 53, 90, 96, 171 total. So this year so far, just starting in January, she did 85. This is my total from the beginning as of July of last year. Now, I wasn't a very good trader in the first 6 months. Let's say that. So this year, I'm doing better. I'm up 171%. Okay, now I feel better. I'm beating Kathy Woods. I'm beating Kathy Woods just in this year. That's my total since I opened since I started doing this strategy, July of last year. So July of last year, I'm 73%. This year, I'm same as Kathy's 85. I'm 171. Okay, now I feel better. See that? 171. That's just from January, which is what we did Kathy, right? She just did from January. She just did January. That little thing. All right. I was feeling bad, but now I feel better. Okay, so this is just 1 year. So Kathy did 85% in 1 year. The S&P did 18% in 1 year. Let's put the Qs in there to see what the Qs did. Well, the Qs kicked the S&P's butt. All right, the Qs did 25%. So that's really good. This is a really good year. You can see down here the by month. So Kathy did 73 total in the year. And when we go over to my spreadsheet, I've done 171 so far this year. All right, so I still feel good about coming and showing you my strategy. All right, so what I do is I trade the yield max funds. And the reason I trade them is because it takes profits along the way. And then when the market goes down, yield max doesn't add the money back in. They do. They actually take money out. So what they do all the way down, they take money out. They take money out all the way up. They take money out all the way down. So if you want to put money back in that they take out, you have to put it back in yourself. So there's still some work that you have to do. It's not as easy as just handing Kathy Wood your money and saying, well, Kathy, I'm happy with 85%, which a lot of people should be happy with 85%. She's outperforming the S&P by hands down. But I outperformed her twice, okay, or more than twice. I did 171%. Okay, during the same time period. So no, what did I do? What did I do? Now, what I do is I break up my strategy or break up my market, my thought process into individual stocks or companies, right? So this one here is Tesla. This one is Tesla. This one is basically around Bitcoin. This one is around Bitcoin. I like my little pretty pictures. I did that just for you guys. And then this is another one that's based around Bitcoin. I got a lot of money in Bitcoin. In fact, I added those up and I've got total Bitcoin. I got $324,000 in Bitcoin derivatives. So I really need Bitcoin to go up. So I got $324,000 in Bitcoin. And then I got $206,000 in Tesla. And because I got 2 Teslas. These both are Tesla. All right. And they're derivatives of Tesla. And then down here, I have NVIDIA. And this one here is Palantir. And this one here is YMAG, which is Apple, Amazon, Netflix, Google, Facebook. I can't remember the rest. Google, Facebook. What's the rest? Apple, Amazon, Netflix, Google. NVIDIA. I can't remember. I have to write them all down. And then this one's Robinhood, which you can see I have got no money in. I haven't put anything in there. It's just one that I'm looking at. And then AMD. That's one I'm looking at. Now, you know that I did a little rebalancing. So I took some money out of some of the ones that weren't making money and or weren't doing as well, and rebalancing them into some other ones. I still got a little bit of money in cash up here. So my cash that I've got sitting on the sidelines, I got $61,000 sitting on sidelines in that one. And this one, I think I've still got, I've only got $1,500 in that one. That's my 401k that I self-direct. And it made, let's see, it made 85%. So that one did the same as Kathy Woods so far this year. She's about the same as my ROI on that one. But this one I'm making 171%. Okay. So how do I do it? Well, I take these funds, and then this one here is TSLY. It's not TSLA. And TSLY, why is that not pulling up? There it is. TSLY, here, we'll go do it on Track and Trade. TSLY is actually a fund that you put your money into, which trades TSLA for you on your behalf, and then they take money along the way. So this here is TSLY, and you're looking at it, and you're like, well, that fund didn't make any money. How did you make money on that fund? I made money on that fund because that fund is not anything other than just my bank account that I give to them. The money that they make, they take out and give to me, so it's not in there. It's in my account. That's how I make money. They take money along the way. They take profits along the way. She's like, I don't want to buy that. That's a crappy fund. Well, it's not rising. We'd like it to rise a little bit, but mostly they're just taking the money out and giving it to us. And so if they take the money out and give it to you, then it doesn't rise. This is a representation of your cash that you've got. It's not your growth, because these are not growth funds. TSLY is not a growth fund. TSLY is a profit fund. It's a fund that gives you money. And then if you take the money out, just like we were talking before, if you put 10,000 in and you make 2,000 and you take the 2,000 out, well, the 2,000 is no longer represented in your account. So this is your account. It's not a trading fund. This is not your investment. And that's the important thing that most people don't understand and with these yield max funds. So if we go to a yield max fund, you look at Snow. Now this one actually did look at how oh no, this is the real one. This is the underlying. Where's SN Snowy? Okay, see this? This is well, even Palantir is even a better example. This is PLTR. This is Palantir. Everybody loves Palantir. Palantir is going to the moon. And we got a lot of Palantir. How much Palantir do we have? Not enough. I can tell you that, because I did take some profits and put it elsewhere. So I've been taking profits out of Palantir. So here's my Palantir. I have $92,000 in Palantir. That's how much I put in. All right. And I'm not guaranteeing that these are right. This does not look right. Oh, actually it is. I'm up 36,000. That's why I took 68,000 out of Palantir. So part of my profits that are sitting on the sidelines are part of that. So I got 61,000 in cash. So you can see I took some money out. I've been taking profits. And I put, oh, there's one. I put 20,000 back in over here in Bido. I took 26,000 out of NVIDIA. I took 68,000 out of Palantir. So I take a little bit out as it puts money in. So I'm $36,000 under parity, meaning there's still $36,000 of profit in there, even after taking 68,000 out. Is that what that's telling me? This is my new spreadsheet, and I'm thinking about things in a totally different way. And so that's why I want to show it to you, because it's a little bit different. I'm not sure that I'm not guaranteeing that the numbers are actually 100% correct. But that's my capital investment. I put 92,000, which has gone down to 73,000, but I've accumulated 41,000. All right. So 41,000 plus 73,000, 7, 8, 9, 10, 11, almost 12 is over 92. And that's the overall growth. But I've taken this money and I'm rolling it back into these funds. I've been buying a lot of Palantir. You can see as I come down, I've got Palantir going in, putting money in, putting money in, putting money in. And then as it was down low, and then now I'm starting to take money out, take money out, take money out. So I do the dollar cost averaging with my yield max funds so that I have some money on the sidelines so I can put some in. But I don't put them back in based on what the yield max fund does. So the yield max fund down here, here's Palantir. I don't trade this chart. This chart to me is really pretty much irrelevant. I don't hardly ever look at it. It doesn't mean anything to me because I'm not trading that chart. That's the chart that I have my money in. My money is in PLTY, but I don't ever look at that chart and say, oh, it's dipping. Oh, I'm going to take money. Oh, I'm going to get out. Oh, I'm trading. No, you don't trade this chart. This is just your account that your money's sitting in. This is the one that you trade right here. So you look at the real money, and if it's rising and it's getting way up there, we're going to take some profits off, right? We got to take some profits off as we make more money so that when it dips, we can buy back in with the money that's free from us, right? Now, the great thing about it is they also take money out along the way. Okay, that's what your dividends are. They're taking money out. So I'm taking money out as market goes up so I can have lots more to put in, but they're also taking money out. They didn't take enough out, so I took more out. That's the way that works. So you get a distribution every month. They're taking profits out, which is why this stock never climbs, because it's not representative of the Palantir stock. This is just, if they never took any money out, it would keep going up. This is like your cash. This is just a cash holding account. And that's what most people don't understand about Palantir and how they work. This fund right here, this PLTY is not anything but just the cash that you've got invested. You got 10 grand in there, it's going to sit right here. But then if they give you $2,000 in dividends, that's why this market doesn't rise, because you got to think about this as your wallet. This is your investment account. So here's an example. This is the part a lot of people get screwed up on. They don't understand. What is PLTY then? PLTY is this right here. See this? In track and trade, you have a cash balance. That's how much that's your buying power. Now we've got in here, we've got a cash balance. We got buying power. We got a buying power of 245, but that's because we've got some margin amount. But our cash balance is 124. Okay, so we got $124,000 that we can invest. That's sitting over here in an account that's not being traded, right? So if we trade it, we have money at risk. So if we give our money into PLTY, we have taken our money and we've given it to them to trade. That's now their representation of our 124. This is not something you trade. You don't trade PLTY. PLTY is where you put your money so that they can trade it on PLTA. And then they take the money when they make it, they make a profit. They put it in here. So it'll go up and it'll go down as they make money and lose money. This market will go up, but it's not PLTY that's going up and down. It's the value of their holdings. It's how much profit they've made based on how much money you've given them. It's this number here. It's their cash balance. If they make money, the cash balance will go up. If you lose money, the cash balance will go down. But then they're going to take money out and give it to you every month, which is the distribution. So that's going to make this market go down, because if they make 10,000 and the market goes up and then they take the 10,000 out and give it to you, well, then this fund's going to go down 10,000. It's a hard concept for people to understand, but that's the way this thing works. And so to try and relay that to you and get that through to you is kind of my goal. I want you to change your whole thinking, your whole mindset. But Lan, I invested in PLTY. No, you didn't. You gave Palantir $10,000 and they put it into PLTY, and that's their holding cash that they use to now go invest in PLTA with, or PLTR with. And then when they make money in PLTR, they take it back and put it back into PLTY. Now, if they lose money because they took it out, which makes the market go down, they makes PLTY, they take it out. Okay, go put it over in PLTA, and then they lost it. Well, this goes out not when they lose it over in PLTA. This goes down when they took it out to go invest it in PLTA. Now they didn't bring it back because they didn't have anything to bring back. So PLTY doesn't go up. And the reason it goes down is because they keep taking money out to go invest it somewhere else. And then as it goes down, it goes down, it goes down. And either they bring it back and put it in, which makes it go up, right? That's what's going on here in PLTY. And other people will come and put their money in there too. They'll come and you come and put money in, and I come and put money in. That'll make the market, this PLTY, go up, but then they just take it out and go invest it. Because if you give it to them, you're asking them to invest for you. So you put it into PLTY, they take it out and go and invest it. And so this market generally just kind of stays sideways, because if they take a big winning out of PLTY and put it back in here, well, it'll cause this market to go up. But then as soon as they have their distributions, they give those profits to you. They take them back out and give them to you as a distribution. So this PLTY never does really rise, because they are always taking the money out and giving it back to you. That's what your distributions are. And that's how they have such big distributions, because they're constantly taking profits out of PLTA, putting them into PLTY, and then every month they pull it out of PLTY and give it to you. And you can go buy toys with it and candy and pay your bills and buy expensive things. And then you can say, oh, well, I have some extra. I didn't buy a whole lot of candy this month and toys, so I got now a little bit extra. What do you want to do with it? Well, you can give it back to them, PLTY, and they'll take it and they'll go invest it some more into PLTA. But you can come over here and look at PLTA, and you can say, PLTR, and you can say, well, PLTR is getting really high. I don't know if I want to give PLTY my money to go invest in PLTR right now. They might lose it. There's a chance this market might come down, and if they do, they won't they won't give me back my money, my profits. So you could look at that. That's why I say I look at this chart and see if it's a good idea to give PLTY my money to invest in here right now. It's getting pretty high up in here. I'd rather be taking some money out of here and putting it somewhere else. Not that this can't go higher. It certainly can. It's just the odds are low that when a market gets up into this region, that it's going to continue higher. Usually, historically speaking, right, we get a drawdown. We get a little pullback in here. That's why I have my little marker right here. It says buy PLT here. Now, is it going to come all the way back down to there? I don't know. In past history, it has. The further we get out, this will keep going up. See, as it rises, it'll follow up, but it follows up by a certain degree. So the less time, I mean, we can make that line go up higher if you want. Right now, if you come in here to Donchian channel, it's just a number I put in here. It's 100. If we bring that down, how aggressive do you want to bring? If you bring this down to 75, see, or 50, there's 50 right there. Now our buy is way up here. Okay, buy PLTY there. You can start there. That's a good place to start. That's why a Fibonacci ruler, when you put a Fibonacci ruler on there, has multiple lines on it. All right. Where do you want to start buying? I like to generally start buying at 38.2. And then if it falls down all the way down, if it comes down here to 38.2, I'll buy some there. And then it goes back up. If it comes back down to 50, I'll buy some more there. If it goes up, and then I'm good. I've got money going in. And then as it starts to rise, if I get a pattern like this, where it comes down and then goes back up, I'll buy the little dips going up each time like this. So now I can buy here. So I'll buy here, I'll buy here, and then I'll buy here, and I'll buy here. All right. So as it's down and it's curling and it's starting to go back up, I'm buying the dips. All right. As it goes up. That's why we have these numbers. If it comes down here and goes up, oh, get the right. Ooh, come on, Lan, get the right tool. If it comes down here, then goes up and I buy, and it goes up, and it comes down here and I buy, and it goes up, and it comes down here and it hits the 61.8, then I buy even more. I buy a lot more down here if it'll hit this 61.8. Because if I believe in the company that it's going to turn around and go back up, it's given me an opportunity to buy some more. So I'll buy all the way down here. There's even one more line on the Fibonacci ruler, and that's why you have multiple lines, because it's telling you, hey, buy some here, buy some here, buy some here. Dollar cost average in. If it keeps coming down, you got one more down here. Oh, now I turn them all off. I want to turn it on. Come on, right there. So now I got one down here. If it comes all the way down here, you have to be careful, because then the market might be in a downtrend. But that's okay. You can buy down here. You're buying the dip. You're buying on the way down. Okay, so you can buy down in here, even if it goes even one more. It gets scary when it gets down that low. But that's where that's what those numbers are for. They tell you where to buy into the market. Now, how aggressive do you want to be? Where do you want those numbers to be? Well, how far back are you going to go on the trend? Because that's all determined by you. See, I went all the way back to the lowest low. But the market's really been going, but it's got a nice 3-drive pattern. So generally speaking, historically speaking, we do the whole trend, which is what we call the Darvas box. One full Darvas box. From here, oh, come on. From here, come way out here, to here, to the peak. Now, right now, the Darvas box is right here. But if it breaks higher and goes higher, then we make the Darvas box go higher. So back at this level here, the Darvas box was clear back here. All right. But we knew the Darvas box was only on the second drive. So, well, this one here, it looked like a third drive, but just kind of combine those two. You can see now that's one drive. Historically speaking, I mean, past performances, 2020 hindsight. So we can look and say, we're in the third drive. And so now we're coming up here at the third drive, and this is right now currently where the top of the third drive is. If it breaks higher, well, we'll just make it go up. Eventually, we're going to look for the ABC retracement, and then that would be the bottom of our stop. Wait a second. There it is. All right. So that would be the top of our Darvas box, and we're going to expect the ABC retracement, the 2 drives down. That's a standard Elliott wave. All right. Standard Elliott wave. And why does that work? Why do we see that pattern over and over and over again? Because the big banks and hedge funds have programmed it into their quant systems, and that's how they trade. Because that's what they do. They sell all the way up the uptrend. Eventually, they run out of money. There's no more money to sell, so the buyers don't have anybody to sell to them. They kind of run out of money. And so They've sold it all. So they got it all sitting on the sidelines waiting for the market to go down so they can buy back in. And then the retail traders, they've all bought in. So now at this point, retail traders are pretty loaded with bear. They're almost all their money's in the market. They don't have any more unless they run out and work and take some out of their paycheck. All right. All their savings are in the market already by now. Thing's gone up. And they like to buy all the way up these uptrends. They'll buy, and build themselves a great big upside down pyramid, remember? So this is what we're looking for. And the reason I like this strategy is because now that's Palantir, and we trade Palantir based on whether we want to put our money or have Yield Max trade Palantir for us. So if I come back over to PLTY, see Palantir here has just gone, bleh, it's dead. But you're not trading that one. You're not looking for growth on this. This is just your holding pot. It's just a pot of money that you put your money into that they draw from to go trade in Palantir. Now they don't trade at Palantir by buying the shares. They trade stocks, or they trade options over there. So then when they make the money on the options, they put it back in here and then they give it to you. That's why this is just a holding pot that you don't really look at. Now, do you want your holding pot to go up and down? And it goes up and down, but really you want your holding pot to kind of stay level, or or go up a little bit. Don't give you back all your money. Leave some in there to kind of keep your holding pot stable. You want a stable holding pot. If this thing's just tanking down, that means they're not making money. They put it into the fund and the fund loses, right? So they put options into PLTR. If this thing's flushing down, like through here, they kept putting money into Palantir and their options never paid off. So they didn't have any to put back. So they'd pull money out, lose it, 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 pull money out, lose it. That's why this market went down, 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 down. Then they'd pull money out, start investing it, and then they started making money. And they put more in. They put it back in. They put more in. They take their profits and put it in. Then the market started to go down again, and they're pulling money out, but they lost it. Pull money out, they lost it. Pull money out, they lost it. And then the market started to go up because they were making money. So now they're putting their money back in, 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 putting their profits back in, and this market starts to rise. So this isn't really the market that you're concerned about. This one is. And if they're making money over here, which they make money when the market goes up, right? And so all through here, you're like, well, wait a second. Palantir's been going to the moon. Why is it that this didn't go up? Because they're giving you the money. They take it out, put it back in here. This goes up, and then they take it out, and they give it to you. And then what happens is we record that in our spreadsheet over here. I gave them 71,000, and every month they've given me back. They gave me 8,000 back, and then they gave me 3,000, and then they gave me 3,000. That's 8,000 over. That's like a 4,000 and a 4,000. So that's added together because it's 2024. So we started in January. In January, they gave me on my 71,000. They gave me 3,400. Then I gave them 9,000 back. I put 9,000 more in. So then they gave me 3,300, which is actually less than this one here. So even though I put 9,000 in, I got less back. Why? Because they put money in and they didn't make any. So then I give them 20,000, and then I got 3,000. So now I've put 70, 80, 90, 99,000 in, and I'm not getting any more back. These two, I didn't get many more back. Why? Because they put it in and they didn't make any money. But because I have the number of shares, this month I got 5,000. And then I put 30,000 more in, and now I got 7,000 back. So they took my money, they traded it, made $7,900, and they gave that back to me. I've still got my 71,000. 70, well, more than that. 70, 79. I ought to have a running balance of what I put in and out, huh? That would be another great column to be in here. I need a running balance of ins and outs here. Well, this is not a total. This is just what I put in. I need a running balance. Maybe that's how I should do that. That's a nice way to look at it, huh? I wonder how I can do that. I wonder if I'd need a new column or if I could just do it right here. Because if I just do it right here, I would see the running balance, but I wouldn't see the input. I wouldn't see how much I put in. It would be hidden behind the scenes. I wonder if I want to see the balance that I put in. I don't know if I care. I think I only care about the balance, don't I? I think I'm going to turn this column here into a running balance instead of just a an additional capital added. So I added 30,000 there. Of course, that's nice to see. Of course, if you want to see it, you can look up you can see up here in the window. Maybe I'll make that. Oh, now I screwed it up. Doggone, I hate Excel for that. Now I'm going to do this, and that screwed it up. Now I got to go undo. Don't ever do that. All right. And then I put 14,000 in, and I got 4,000. See, now I put 30,000 in, put 14,000 in. This is Tesla. And this month I made 7,900. Then it went down to 4,000. Then I made 5,000. Then I made 4,000. But yet the whole time I've been adding money in. That was a good month right there. We made a lot of money in Tesla in May. And then 4,000, then I made 5,000, and then I made 4,000. And that's the money that they're making, giving back to me. And then I take that money, and sometimes I'll take that money out and I'll reinvest it. But this is the money that they're taking out. So they're always taking profits out. Remember how I said dollar cost average out, dollar cost average in? Well, they're dollar cost averaging out as that market rises, giving that money back to me as a distribution. I take that money, put it in here, and then it becomes cash in my account. It's not in their fund. They take it out and give it to me. Now it's in my cash account. So I have all this cash sitting here. So I can either leave it out of the market, wait for the market to dip and put it back in. And that's what I like to do. If you have it automatically go right back into the same thing you're taking it out of, that's called dripping. I don't do that. Because if you drip, it's just, why pull it out in the first place if you're going to drip it back into the exact same thing? Then you just have to pay taxes on it. So don't pull it out. Just go put your money in TSLA. Just go put your money in Tesla and don't take it out. Then you don't have to pay taxes on it, right? So if they take it out as a distribution, well, now you have to pay taxes on it. You have to pay taxes on it eventually. I mean, now or in the future, you're going to have to pay taxes. Taxes are, the only things guaranteed in life is taxes and death. Right? So you're going to have to pay taxes on it. I pay taxes along the way because I take the money out along the way. But I don't immediately put it right back into the exact same thing I just took it out of. That would be asinine. I just well leave it in there and not pay taxes on it today. So when it comes out, it sits in my cash account, and then I decide all over my whole portfolio, and that's why I have a diversified portfolio. So I can say, oh, well, I got a whole bunch of money from Tesla. Where is a better place to put that? Where's a better place to invest that? Well, I don't see anything I want to really put it into, so I'm going to leave it in cash, and it'll sit there and earn a little bit of interest in cash, and that's okay. It'll sit there and earn a little interest in cash, and then when I see a dip in a market, I can grab some of that cash and go put it in. Be more strategic about where I reinvest. I don't just drip it right back down into the same thing. I might say, well, Tesla's doing well and it's still going up. I might take the distribution and put it back in once in a while, but you can see I don't do that. I don't drip into the market every single month. They don't give me 3,000 or 5,000 here and I put 5,000 back in here. They don't give me 7,000 here and I put 7,000 back in here. They give me 4,000 here, I put 4,000 back in here. That would be dripping. I don't do that. You can see in here, I go in with tranches. I have a big bunch of cash sitting there from when it came out. And when I strategically see a drawdown or a pullback in the market, that's when I take that cash and I put it in. Otherwise, my cash is sitting on the sideline, earning interest up there, waiting for a dip. So you can see right now I have in cash, I have 61,000 in cash, waiting for an opportunity to put it in. Well, let's go see if there's an opportunity. I'm not going to look at this market. I don't care about this market. I care about this market. This would be my MAG versus my MAGY, right? YMAG, this one here. These two are paired. So this one, see that? It's not going up. People look at that and they're like, I'm not buying that piece of shit. Look, it's not going up. That's because they're taking the profits out and giving them to you, and they come to you and you go spend them. You take your profits out, but they're like, I don't get that. They can't comprehend that this is not a stock that you're trading. This is just a holding account. You got to give them your money so that they can trade it for you. And what are they going to do with the money that you gave them? Well, you can see it. It's right there. And you can see if they're making money or not, right? They're making money because it's not going down. If it's not going down, they're making money. Okay? If it's going sideways, that's fine. That's perfectly fine, because that just means they're making money and they're giving it all to you. And then you can decide if you want to put it back in, or if you do put it back in, it'll cause this market to rise a little bit. But then they'll just take it out and put it into, something else. They'll invest in something else. This market's not supposed to rise really big. It's supposed to just be a holding, because all the money that comes in there, they take out and give to you. So it doesn't go up. If they didn't ever take it out and give it to you, it would go up just like YMAX. But then what's the point of having this fund? The whole point of this fund is so they give it to you. And once they give it to you, you can go put it in other things. You don't have to put your money back in another YMAG fund. You can go put it in Tesla, or put it anywhere you want. I got a buddy who takes it out and goes buys equipment with it for his company, because he feels like by using this money gives him like free money, right? Compounded interest, compounded money, free money making free money, free money making free money, free money making free money. Once you put it's like priming the pump, right? Remember Claire's article about priming the pump? Some of you guys read Pit News Magazine that long ago. Some of you go to Sunday school and you hear that story. You got to put the water in to prime the pump. Once the pump is primed, then you can pump the handle and water comes flowing out. Free water, free water. It's not part of the bottle that you put in there. So this is your pump right here. I primed the pump with $459, and the pump gave me $333,000 back so far. All right, almost to break even. That's what this number says. In 4 months, it will have given me 100% of everything back that I put in. So I pumping the pump, and water's come flowing out. I've almost got a whole bottle's worth. Everything I put in is almost back out. That's pretty cool, right? Because once I get that 459, in 4.69 months, I'm going to have $459 back. And then it's pure profit. It's 100% house's money, right? Just like in Vegas, I've got all my money back. I put that back in my pocket, and I'm playing with the house's money. I have no risk. And then I put in, because I take some of that money out and then I turn around and I put it back in other places, right, to grow my account. That's not my initial money. Now I have total reinvested dollars. I put 216 of that back in already. So out of that $333,000, I put 216 back in. Jay says, I used to travel, and now he doesn't need any money. He doesn't travel anymore? I don't need any money, Lan. Okay. I call money the grease of life. You got life, and if you have money, it just helps you slide through a little easier. The less grease you have, the little more friction you have along through life. Maybe a little friction's not so bad once in a while, right? I don't like it though. I like to have a nice slick life. So this is how this is working. So that's how these funds work. And if you like that idea and you like that concept, I run it like a business. So I look at each one of my YieldMax funds as a machine that's producing an income for me. And I've even got a label like this. This is my capital expenditure, my current expenditure or capital asset value. So I bought a machine, I bought a Tesla machine, and that Tesla machine is kicking out for me. I paid $71,000. The total capital investment I paid is $181,000 for that Tesla machine. And every month that Tesla machine kicks out $4,000 to me. This is how much money is coming down. I go down, 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 down. I got $26,000 left before that Tesla machine has completely paid for itself. And everything is pure capital cash at that point. I'm playing on the house's money in $26,000. All right. That's to get to a cash machine, to get my initial 71,000 back. But this is all free money making me free money. This is my compounded money making me money. And so I put that back in. So now I have $101,000 of original cash plus my free money cash. This is exponential growth, right? This is where I get my exponential growth. So my exponential growth is going in scientifically, mathematically calculated. So I'm doing my very best I can to try and put my money back in a little bit better, not just drip it back in. And that's why I'm up 171,000 on the year, 171% on the year. That's pretty good. I have to think that there's not very many people trading the stock market who have made 171% this year. I don't know. My experience in the stock market says that if you make 171%, you're doing pretty good. So if you like this strategy, you can do it too. I'm not telling you what to do. I'm just showing you what I'm doing. And this is how I'm doing it. This is how I think about it in my brain. So if you want to make 171% on your money, think about your portfolio the way I think about mine. That's all I'm doing, sitting here. I'm not telling you what to do. I'm just showing you what I'm doing. I'm telling you my thought process, you know, just telling you my thought process. So you guys have any questions? I'm working on, you know what? Excel, when you become a real Excel guru, you're like really good at Excel, you realize how many bugs there are in this thing. This thing is so loaded with bugs. I find so many bugs in Excel. It's unreal. It's not a very well written program. It is loaded with bugs. Some of the user interface stuff is just laughable. You're like, who in the hell designed that? Had to have been a programmer. It wasn't a design engineer. I fancy myself a design engineer because I don't write code, and I've designed lots of software programs. So I fancy myself a design engineer. And I used to, I laugh. I tell the story that when I ran my software engineering firm, we had an employee named Marlene, and she worked up front in the marketing department. And we would always go back and take the software. And when we come up with a new feature, we'd go take it to Marlene, and we'd give it to Marlene and say, all right, Marlene, without reading the manual, can you make it do this? And if she could make it do it without reading the manual, we figured we had a pretty good product. But if she couldn't figure it out without reading the manual, then we had to go back to the drawing board. Called it the Marlene test. I'm telling you, Excel. I know it's a financial document, but it's still user interface stuff. All right, you should be able to figure it out. And sometimes after you've even done it 10 times, you're like, I still have to read the manual to figure out how to do this because it's so stupid. Some of the things they've got done in here. This is really not a very well written program. You think Microsoft, but better than every other spreadsheet out there. And it does a whole lot more than Google's little spreadsheet. Google spreadsheet's free though, but you know, that's always nice. You have to pay for Excel. You don't have to pay for Google Sheet. And for most people, Google Sheets will do about everything you want. Google Sheets will do everything I'm doing here. Well, no, the way it does it, the way it retrieves stock data is really weird. I've not been able to figure it out yet. Apparently, it's supposed to be able to do it, but I can't make it do it. So I can do it in that. That's one thing that in Excel is a lot better than the Google Sheet, getting the data. So, anyways, I've used Excel my whole life. I'm not very good at the Google Sheets. But this putting charts in here, that's another thing. Yeah, I'm just complaining. When you go in here and you create your spreadsheet and you try and put these little charts in here, this is a nightmare. This is really hard to get it to do this, believe it or not. And you can't do it off the data that's in your spreadsheet. You have to come and create a little helper chart. What they call a chart helper. So you have to create a chart helper of the data you want to put in your spreadsheet. You can't pull it from here. No, that'd be too easy. You can't just highlight it over here and say, I don't want to put a chart in there like that. I mean, you can, because you can then call that your chart helper. But then if anything changes, it's stupid. So you have to create a little chart helper, and then you make your points come from there. See, so this is like L49 for my chart helper, and then I take my chart helper. I put that in here to make my chart. It's just a weird way of doing it. That's how they in the manual. They said, create a chart helper. Okay, I'll create a chart helper. All right, guys. I don't know if you have any questions. Jay wants to look at the BB chart. Let's go look over at charts. All right, my UBI portfolio. You see my UBI portfolio. You understand how I'm doing this now. Let's go look at BB. Is that Bed Bath? Oh, that's Blackberry. Whoo, look at Blackberry. So if we take our Fibonacci ruler and put it in there, go to the top, that's what really peaked out up in there, didn't it? And then it flushed like a toilet, and we're down here at 61.8. So there you go. That's a good space to, if you believe in Blackberry and you think this company's got a future, and you think they're going to go to the moon one day, or they got good products, fundamentally speaking, let's go look at them in a fundamental sense. All right, should we? Go look at their BB. BlackBerry. Blackberries used to be the thing, man. Everybody loved their Blackberries. And then Apple came along, came out with the iPhone. All right. So earnings. Oh, GAAP earnings. We don't care about that. The revenue. What do they sell? Do they still sell little BlackBerry? What does BlackBerry sell? Do people still buy their little BlackBerry phones? Jay, what do they sell? I don't even know. They used to be the hottest little thing. They were like the iPhone of the olden age when I was younger, right? And they had little keyboards on them, and you type with your two thumbs and stuff on your little physical keyboards. Not like on iPhones where the iPhone is. Let's go pull one up and look at it just for fun. What's an old BlackBerry look like? Old BlackBerry phone. Images. Where's our images? Yeah, look at these. This is what they used to look like. Little physical keypads on them. And people loved that. And man, they had a hard time giving that up because they could have the tactile feel of a real keyboard, right? These are old Blackberries. What's the new BlackBerry phone? Is that what they're selling? They still sell like an iPhone BlackBerry? New BlackBerry phone. Images. So they still got a physical keyboard. See, people can't give that up. That was the thing about that's the thing about the BlackBerries. They go into the iPhone. They hated the iPhones because they didn't have a little physical keypad on them. They reinvented themselves as a contract with some maritime company stuff. I saw it on the Navarro show. I saw they reinvented themselves and have a contract with some maritime company stuff. This is the best BlackBerry phone of 2025. That's their 2025 version right there. So it looks kind of a combination. It's got look, there's your Google. So it's like an iPhone, only it's got the physical keypad. Okay, so let's go back and see if they're selling these babies. So it looks like somebody got excited about them and then they fluffed. Let's look at this. So their earnings per share has gone from a negative 192 in 21 to, that's weird, back down. This I loved seeing. Shares outstanding are not going down. So they are not buying back their shares to prop up their earnings per share. And their earnings per share going up every year. Their sales have gone way down. Look, in 2021, Jay, they were at 839, 893. Then they went to 718, 6, and then they bumped a little in 2024, but now they're way down. Of course, we haven't got the full year in here. This is 2025 so far. So sales right now are at 551. If we take 551, you want to do a little deeper analysis on this? Let's go in and see. So if we take current sales at 551, and we divide that by how many months? We're into, let's not count August. Let's just go 7. That's 78 billion. Or no, there are millions. Okay, this is millions. Okay, 78 million a month times 12 would be 944. So holy cow. If that goes forward and they make the same amount of money, this will go all the way up to, it'll be the biggest year they've had since 2021. So now you're seeing upgrade. December was the last time they got an upgrade by TD Securities. Well, nobody's talking about them. BlackBerry surpasses market returns. Some facts worth noting on Zacks, and that was on August 13th, which is yesterday. What a lagging tech bet tells us. Is Apple making the same mistake as BlackBerry? Here's how it can change course. BlackBerry registered a bigger fall than the market. Important facts to note. That was on July 25th. What happened to BlackBerry stock this year? BlackBerry suffers a large drop in the general market. What did they say? Market. BlackBerry suffers Zacks. In the latest closed session, BlackBerry was down 2.57 at 360. Now, this was back on the date of this was August 1st. So August 1st was June, July, August. Oh, that's back here. I want to see the news around, what's that date? I want to see the news around June 26th, June 27th. June 26th, June 27th. BlackBerry stock soared this week. That's the 27th. 26th, BlackBerry soars. Earnings optimistic. Concord raises BlackBerry price target. Keeps hold rating. Is BlackBerry on track for a $508 million, $538 million fiscal year 26 revenue from Secure Zacks. Analysis report BlackBerry Limited Morningstar Research down 5%. BlackBerry Limited, a bull case theory. Raymond market performs on BlackBerry after first quarter results. Nobody's talking about the big flush. They're all talking about how great it's doing when it hit that really super high. Badger meeting. Nobody talked about why it fell. I don't know. We have to do a little more deeper look. But that right there, I don't know why this, it might just, I don't think it's just profit taking. This was exuberance, and then this was down. Could it be a slow rise? Could be a slow rise. I don't think it's going to shoot up like this out of here, but it would have to catch the eye of a bunch of people for one reason or another. It's going to have to, let's get back over to track and trade where we can draw on it. So we're at 61.8. It just broke the blue lights. We're down in the accumulation stage. So they started accumulating down in here, going through the Fibonacci sweet spot. That's the accumulation stage. You can see it corresponding. So yeah, buy it up, man. If you like BlackBerry, buy it up. Trade. Put 100 shares in it. That's nice. It's only at $3. $3,000. Buy 1,000 shares. We'll buy 500 shares right now. And we'll come in here. We'll watch this with you. Jay, come into options. Do they have any options? They got some past options. The volumes really sucks. That's one day though. Let's go out and look at 100 days of option. Let's go out. You could even just do go till the end of the year. Just how well you think they're going to do. See, well, there's some pretty good money in here. The spread is not that bad, only $3. I don't know. The volume is 0 today. Where is everybody? Nobody's buying it right now. Volume is 0 on it, everything. Now, we've been having some, I don't know, but this is also, oh, look, somebody bought 100 of them here. That's puts. Oh, no wonders. Let's buy calls. Let's go back out to January. Okay, now we're starting to see some people buy. We got 200 of them here. I like to buy them in the money just a little bit. We got 7,000. Oh, look at how far back that is, though. Let's do this one. Oh, that's 0. What's the spread on it? $4. That's why they're buying them up there. $2 spread, but I don't know. I guess you could do a little bit out of the money. I kind of like to buy them a little bit in the money. I like it right there, but they're buying them down here. There's 25. How many would we buy? Let's say we want to put $5,000 into this thing. There's 2,500. There's 5,000. So there's 5,000, and this is until 155. So this expires in January. we would have 79 long calls. It's not quite 100, but each one represents 100 shares. So we could come in here. Let's go ahead and see if it'll even let us have it. It's in the demo account. Let's see. So they're asking 66 cents, and we're at 64. So let's go to 66 and see if they'll let us have it. They probably won't. Oh, they did. They gave it to us. I didn't think they would because that volume is 0. And oftentimes they'll go off of that and say, well, is anybody trading it? No. Where we're going to simulate that you couldn't get it. Okay, so we are the volume at this point. So we just put in 50. So that would show up as 50 if you're in the real market. So now what we're going to do is we're going to come in here and we're going to sell some puts. And we're going to sell them. Should we sell them right at the exact same price? Let's sell. How many was it? 47 or something? Position chart. 79. So we're going to sell 79 of these things. So we're going to receive 3,000. Now we paid 5,000, so we're going to have a $2,000 debit. That's okay. It still gives us down to 3. It puts us in. We're only in with $2,000. Okay. So now we're going to come in and we're going to go to 38. Go 37 just to make sure it feels. Okay, so we got that one. All right, so we got ourselves a nice little synthetic long position. All right, so how many do we have? 79. 79 times 100 is 7,900 shares. So we've got 7,900 shares. So let's come in here and we're going to go to preferences. And we're going to say that we have 7,900 shares, 7,900 shares. And that means that if this market went just back up to where it previously was by the end of the year, and that's by January, we would make $13,119. And our investment, our cost to do that is $3,000. All right, because we got our $2,000. So for $2,000, if we believe, oh, you guys, can you see this? Doggone it, I always get in the way. I hate this thing. Sometimes I don't know why you even need to see my face. All right, there you go. So that's how this is turning out right now. We went in and we bought a bunch of shares. So we're going to see the difference. All right, we'll watch this with you, Jay. We'll track this out. And so we're here at 61.8 and we're broke the blue lights. We're going to anticipate a rise in price. Doesn't mean it has to. It could keep coming down and we could lose some money. And we're going to lose money the same as if we had 7,900 shares. So we have no protection to the downside, which we could buy if we want to. We could come in here and we could buy some protection to the downside. We come in and we say, well, if that market keeps going down, I don't want to hold on to it. Or you could just take the loss, whichever you want. So right now we could come in here. We can protect it at any point by we can't short it because there's no easy to borrow. So we can't just short it. So we do have to have some protection if we're going to do it. So we could come in and we could protect it for the next 30 days. And we could buy some puts. And how many puts do we want to buy? Just enough to protect it for 30 days to find out if it's going to go up. So how many? We got 79. So we're going to buy right here at the money. Not that one. We can't do that because that would just liquidate the ones we already have. So we buy down here. Okay, so we're going to buy. If we have 80, let's do 40. We do it's a hedge. It's not a perfect hedge. A perfect hedge would mean we'd have to have 79, right, to hedge the whole thing. But that would be expensive. That would be $3,000, and we don't want to give up $3,000. So we'll give up $1,500 and just do a hedge. So if it goes down, we're still going to lose, and it's going to bite, and it's going to hurt. It's going to chew a little hole in our heinies. But if it goes up, we got $13,000 in profit potential if it just breaks the previous high by the end of the year. All right. All right. Now that purple line is that's for our insurance policy. So let's go ahead and take 40 of those and we're going to buy that. So we got to go there asking 75. Ooh, I don't want to do that. I can't do that. Look, $75 on the spread. We're going to go up one more. I can't do that though, because that's where we're in stuck trouble. We're in stuck trouble. I guess we could do it up there, but that's well, buy some puts as insurance up there, paying a little bit more for it. It's okay. It's better protection. We're already in the money. We're buying some money. And it's okay. We'll do that. So it's $1,700 for our insurance policy. And if the market goes down, of course, you'll lose all that if the market goes up. But that's the idea. It's just an insurance policy, right? You're going to pay a premium. That's your insurance premium, $1,700 for 30 days to protect your $13,000 investment. And if the market starts to go up, you can just liquidate it. You don't have to lose the whole 1760. So we'll go in there, and now that's better on our spread. We're going to go down to 40. We're going to go up to 42. Ooh. Oh, that's better. Oh, 46. Because I'm buying those. So I got to go to 46, $160. So we're going to go, it's going to cost us $1,800 for that insurance policy. That's the only choice we've got if we want to buy insurance. Okay, there it is. So now we're insured to the downside on 50% of our long side position, which is a synthetic long, which only costs us $2,000, and we're paying $1,800 for insurance to the downside. And we got long position. We just bought 500 shares just to show the difference. All right, and then our expiration is clear out here. There, this thing keeps scrolling. Let's auto scale off. Okay, so there is our expiration for our option right there. This is for our insurance policy right there. So what we're saying is we need this market to go to this level. Let's draw a horizontal line all the way across there. Okay, we need this market to go to here. From here, where it's currently trading, all the way up to here. By expiration, clear out to here. All right, that's how long we've got to get this market above that purple line. And if it goes up and breaks that high, if it just goes up to that purple line, that would be $13,000 in profit, minus our insurance policy, however much we lose on here. Well, now we put up 1,800, so you have to subtract that from your future profit potential. Or if the market just goes straight down, you're going to lose money on this one big time, but it'll help on this one a little bit. It'll take away the little bit of the sting, but that'll come out of here. Your losses will come out of over here. Okay, so now there you go. That's how you would trade that BlackBerry if you want to do it with options and be quite aggressive in anticipating that market's going to rise and go back up and break previous highs before the end of the year. If it does, you'd make $13,000 on a $2,000 investment. That's the love of options right there. All right, Jay. Thanks for the chart. That's a fun one to look at. Might be fun to go put a little bit of money on there, and we'll see. And if you guys have any other questions, let me know. But for now, I think we're going to call it a class. And we got to come over here, and we got to do a little bit of this.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. And then, of course, we got to just listen to Claire for one more time.
You know how some people read Pitt News magazine for the charts and strategies? Me? I started reading it for the pictures. And now I write for them. Go figure. If you want trading content that's smart, useful, and doesn't put you to sleep. Oh, and occasionally features me making up terms like tail fuzzies. Head over to pittnews.com and subscribe. And hey, if you find my picture in there, don't judge. They caught me mid-espresso.
All right, guys. That was a fun class. I hope you learned something out of there. And if you did, give me a little thumbs up. Let me know. That's how I know you learned something. And we will catch you next Tuesday morning, 8 o'clock, bright and early. I had someone ask me if we could do a little day trading in the stock market. So we're going to do a little day trading in the stock market on Tuesday morning. So come and do that with us, and we'll have fun. We're going to play with bubbles again. All right, we'll go trade bubbles, and we'll do that first thing. Break right out of the morning gate at 8 o'clock a.m. we'll go trade bubbles together. Tuesday morning, 8 a.m., bright and early, right back here. Same bat channel, same bat cave. Take care, guys. We'll see you next time.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.